Hello and welcome to our 5-minute training video on premium financing. Premium financing, to boil it down, is really just a different approach to wealth transfer and retirement planning. What it allows a client to do is avoid having to liquidate assets to pay life insurance premiums. In essence, what they are doing is borrowing the premium payments from a bank. Who would be a candidate for premium financing? Well, there's two main things we're going to look at: health and net worth. Historically, premium financing has been used with older clients, looking really at estate planning. However, in the last couple years, we've really shifted the demographic, and we're looking at anywhere between 18 to 85-year-olds who are healthy. The younger you are, the more likely it is that you are using this for a business planning aspect. You also have to have a strong net worth. Typically, a $5 million net worth is what the majority of carriers are going to want to see. However, carriers are willing to go under a $5 million net worth, actually as low as $1 million if clients have a strong income. So the lower net worth we're going, the higher the income needs to be. As an example, if we had a 35-year-old doctor, maybe he recently graduated from medical school, so he's paying off a lot of bills. So his net worth might only be $1 million, but he's making $350,000, $400,000 a year. A situation like that, a carrier is very likely to be willing to underwrite that client. When do we want to consider premium financing? Well, anytime we are working with a client that qualifies. It really is just a funding option for a life insurance vehicle. It shouldn't be something that we push on the client, but anytime we have a client that is between 18 to 85 and a strong net worth, it should be one of the options that we discuss. Why would we consider premium financing? What we are doing is we are leveraging a lender's capital. Typically a bank, sometimes a private equity firm, are lending us the money to make the premium payments on the life insurance vehicle. Why do we want to do that? Well, clients would want to do that because they want to retain the use of their own capital for investment purposes. A great example could be a business owner. If I have two options, the first option is to make a premium payment of $100,000 a year out of pocket after tax, or a second option would be to borrow the funds and make a very small premium payment, or maybe even no premium payment at all if I'm putting up enough collateral. Then what I get to do is retain the use of that $100,000 to continue to build my business. Now let me walk through two different scenarios that kind of break down the moving pieces inside of a premium financing policy. Initially, what we're going to do is establish an ILET. The ILET will provide the collateral to the lender. The lender is then going to lend the annual premium payments to an irrevocable trust. Inside this irrevocable trust, we are going to hold the life insurance policy. Along the way, the ILET is going to gift the interest payments to the irrevocable trust, and down the road when something happens to the insured, the lender is going to be paid off any balance due on the loan plus interest from the death benefit, or we can also pay off that loan plus interest from the cash value while the insured is still alive. At the end of the day, whenever the insured passes away, the beneficiaries will obviously receive the death benefit. Now, how we use this on a younger client is by borrowing from the cash value or taking withdrawals from the cash value to pay off the lender along the way, and ultimately allowing ourselves to build up enough cash value that down the road we can borrow from the cash value to supplement either business investments or supplement a retirement plan. And here's a more common example of how we would use premium financing to fund a buy-sell agreement. In essence, the business is going to work with the ERT specialists to structure the financing for the premiums. The buy-sell agreement is going to be funded by the life insurance vehicle. Let's say we have a company that's owned 50-50. So owner number one is going to have a policy on his or her life. Owner number two is going to have a policy on his or her life. We're going to work with the bank just like we suggested on the previous page. And since we are using this as a way to fund a buy-sell agreement, let's say something happens to owner number one. The death benefit would go to the company. Owner number two would then use that death benefit to buy out the ownership from the family number one. So therefore, they would end up getting the policy proceeds. And vice versa. If something was to happen to owner number 2, owner number 1 would use that death benefit to buy out the ownership interest of family number 2.